And these predictions are always kind of, we're throwing darts here, guys. We don't know. We're just guessing.
And we're not good dart throwers.
This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
The NAR had a forecast. They had like a summit, and they got people together, and they put together this forecast for 2026. And the headline of theirs is they predict positive recovery with regional affordability hurdles. Now, NAR's, their predictions are okay, but they're usually, they're always a little flowery. Because that's
what they do.
They have an axe to grind. Not that I don't, but I don't really try to do that here. I'm trying to be very realistic. But what they're saying is they think lower mortgage and inventory gains are expected to attract more buyers back in the market in 2026. With local variations in mind, NAR forecasts an overall 14% increase in existing home sales. That's some of the way back. That's not even all the way back, though.
No, but that's a pretty aggressive, I think.
That's a big number.
I would love to see it.
Yeah, no, I would love to see a 14% increase in closings. That would be terrific. Top economists have one word to sum up the housing market for 2026: opportunity. They think lower mortgage rates and rising supply of homes are expected to open up the housing market in the new year, and something the real estate industry and potential home buyers and sellers have been waiting for following 3 years of stagnation. 2 years of stagnation for sure. Yeah, I'll agree with that. I'm not sure about 3. Maybe.
Yeah, I think the numbers between this year, 2025 and 2024, when you look at it on a 12-month aggregate, are very similar.
They are.
They're not distributed the same way,
right,
month to month, but when you look at the total, they're very, very close.
That's true. The National Association of Realtors is forecasting a double-digit increase, 14% in existing home sales for 2026. We just said that already. Now, they do say if mortgage rates drop to 6%, as NAR projects for 2026, it will mark a full percentage point drop from the roughly 7% average at the start of 2025. That shift could unlock, this is an interesting number to me, unlock an estimated 5.5 million additional qualified home buyers nationwide. That's a nice number.
That's a good number right there.
I love that number, including about 1.6 million renters who could finally make the leap into home ownership. We dwell on this all the time, but that's what we want. I want you to stop renting, start buying, not because I get to earn a commission, because I won't, because I'm not your agent, but I'd love to be your agent, but I'm not. But I'm doing it because it's the right thing to do. That's what you should be doing.
Well, yeah, you're going to build wealth through building equity. You're not paying somebody else's mortgage, you're paying your own.
Exactly.
All the positives that come with owning a property.
Yep.
And it's the first step to own additional properties down the road.
Indeed, right, yeah. That first one's the hard one, because you got to write that check and all that. But after that, they become a little easier because you can just transfer equity from one house into another, and then it becomes much more easier down the road. And plus, then you can start to think about investing in real estate outside of just the stock market as well. As affordability has been stretched, buyers are ultra focused on their house payment. Home prices, even 3 to 5% above market, will face longer days on the market. Honestly, sellers haven't caught on yet.
No.
And this always happens. When the market goes this way, it takes a while for sellers to catch on. And they haven't caught on yet.
No, we've seen more sellers come to the market, which has been nice, but they're coming to the market at the historic market price to where we're not seeing that drop in prices as of yet.
Right. In this article, they say to keep an eye on these 10 metrics in your local market, which would lead to stronger home sales in your area. And here's the 10 metrics, and I wanted to share this with everybody. First one is household income growth. Now, we have an issue in Vegas with unemployment right now.
We do.
It's starting to grow, and we're like one of the worst in the country in terms of unemployment. And we're so dependent upon, that's because we're so dependent upon discretionary income for the travel industry. People aren't coming here unless they got a little money to spend.
And it's more expensive to come here too. That's the other factor why they're not.
Although I talked about that earlier in the year, and I think the casinos heard me. They offered a couple of programs, but I don't know if they're still doing them. They should be. You need to have those loss leaders, guys. You got to have them.
Quit charging for parking.
yeah, that's a good one. For us locals, we hate that. Look at job growth. Well, we kind of talked about that. Millennial household growth. I don't know what that means. Millennial household.
I think
is that kids?
Yeah, additional members of the household.
Okay, all right. Keep an eye on that. Increase in rate qualified households if mortgage dips to 6%. We talked about that. Strong domestic migration that drives population growth. Okay, so we're still positive. We still got people moving to Vegas.
Always.
And that's going to continue. It's not as fevered as it once was, but we still have people coming here, and our population continues to grow. Share of sales with price reductions that shows how seller expectations align with buyers' budgets. Well, we kind of just talked about that. Sellers haven't not caught on yet.
No, they're giving concessions. I mean, we're seeing a lot of contracts with concessions and asking for a lot of upfront, either through concessions for closing costs. Maybe they're handling more repairs than they did before. But But I can tell you from looking at a lot of contracts, there's concessions on 80% of them.
Yeah, and I think that's something the sellers have been able to do to maintain and keep their price, protect their price. Is what they've been doing, which is not necessarily the smartest thing in the world to do, but that's what they've been doing, and I understand it. It's an ego thing.
Yes, you said it, not me, but yeah,
it is. I would advise my sellers, hey, let's just drop the price, and that way all of your prorations are a little bit less.
Yeah, the cost would be a little bit less, prorations would be a little bit less, and you also might attract a buyer.
Yeah,
that's the other thing. If you're listed at $500,000 and someone's asking you for 3%, well, you're at $485.
Yeah.
Why don't you list at $490 and just be firm on what you're going to give in concessions?
Indeed.
And you might pick up a different buyer pool there.
Absolutely. Great point, Rick. Great point. See, more listings available at attainable price points. This is something we harp on, is that I just kind of said that there's another article in the paper that talks a little bit about high-rise development in our valley, and we'll talk about that maybe in the next segment, but my point here would be we need more entry-level housing in our valley. That's what we need. We need to get first-time home buyers out of rentals and into owning their own home. Also, the next one is mortgage and rent payment alignment. So you said you just saw an article where rents are coming down, and they are. We've seen, not dramatically, but they've softened a little bit, and certain elements of our rental market have softened a bit because they were overheated. They got crazy during the pandemic, and so they've softened a bit. That kind of feeds into that whole social media maven, these guys' idea that renting is better than owning. And it kind of pisses me off, but not because not because I want to sell you a house. It's because I believe home ownership is important. That's why. And when you say things like, "Hey, you can spend $2,200 a month on rent and put the extra $400 you're saving from mortgage into an investment," I'm sorry.
Yeah, I mean,
not happening.
In theory, it can pencil a certain way in theory, but theory doesn't translate to what people actually do.
Right. And when you're spending the money on your house, and you got to send that check to the mortgage company every single month, and that money does two things. Number one, the value of the home is going to go up over time, no matter what. In any market, eventually it's going to go up. And secondly, your principal is going to go down.
Right.
So you're building equity every time you send a payment, period.
And it's more than that $400 gap.
Exactly. Over time, it's more than that $400, and so let's keep that in mind. Then they have single-family permit growth. This is not happening right here. Where they've slowed down their permit pulls. Most of the builders have slowed down.
Yeah.
They don't want to spec homes like they used to. They just want to build them to order, and I think that's what we're seeing.
Yeah, they're building about 5 to 10 for the development, and they sit and wait.
Yep.
And then when those start getting sold, they'll pull the next ones.
Right. Yeah, they're really not building them until they're ready until they know they're going to get sold. They don't want to carry inventory, and it's understandable in this market. But and what builders were selling, what builders were selling was interest rates because they could. They were just buying big tranches of mortgages, and they were selling these lower interest rates, which is terrific. Great for buyers. Again, an opportunity for entry level buyers. Then we have a growth in mortgage originations as a key indicator of strengthening buyer activity and transaction volume. Now we're starting to see some people do refis. There's a little bit of refi action out there. Are you seeing that, Rick?
Yeah, we saw a good, I want to say it was middle of October, and we definitely saw a jump in refi activity. It's kind of flattened out right now, but
if mortgages get to 6%, you're going to see a lot of refi activity.
And we're not. I mean, we're not far off from that. It's not going to take a lot of bad news in the market to drive rates down another quarter, 3/8 of a point to get to that 6%.
Indeed,
some of the products right now are under 6%.
Yeah, you can get there. I mean, you can buy down a rate right now too, and it can happen. And you can get a variable rate even lower. I mean, there are variable rates out there, and I know they're scary to a lot of us. But they might work under specific circumstances. It can be an excellent program.
Right. And there's a lot more protections in the variable rates.
There is
that they used to have.
Yeah, you're not going to get creamed automatically on a variable rate. This article was written by Angelica Light from Forbes. She's a staff editor at Forbes, and so I'm going to go into some of the things she talks about here. First of all, it starts off with the housing market forecast in 2026. National home price growth has slowed considerably. The U.S. national home price recorded a 1.3% annual gain as of October, one of the slowest growth rates in recent years. Regional trends vary. Sun belts like Miami, Sunbelt markets like Miami, Tampa, and Phoenix have experienced price declines, while major urban centers like Chicago, Cleveland, and New York City show modest gains. Forward looking to 2026, analysts predict a 1 to 2% price growth annually. So kind of what we had this year,
Right.
with stronger appreciation in select urban hubs and slower or flat growth in areas that have already cooled. So they think more slowing in some of those markets. First question, will the housing market crash in 2026? Gotta love this question. It happens every year they ask this question. Ever since we had the crash,
Right.
they always ask, well, when's the next crash?
When's the next crash, yeah.
Okay, so it goes on to say, although prices in many markets remain high, a sudden housing market crash occurring in 2026 appears unlikely. Housing inventory has improved, which provides stability and remains below pre-COVID-19 pandemic norms. Homeowners are also generally financially secure. Here in Nevada, by the way, and I taught a class this morning, and here in Nevada, there's actually law that makes lenders make sure buyers can afford the home before they give them a loan. Unlike back in 2006 when you could fog a mirror and buy 10 homes. Homeowners are generally financially secure with substantial equity, and growing number of households are becoming mortgage-free. These conditions make widespread housing collapse unlikely in 2026, though some markets could experience moderate corrections. That I don't disagree with. There could be moderate corrections. Now, interest rates will play a role in that. Inventories will play a role in that, but we'll see.
There's always a correction. Like it can correct one way or the other. I mean, it just depends. If last year was really bad and it goes up, it's a correction. If it was really good and it goes down, it's a correction. I mean, every year is a correction on something.
This is what happens in capitalism. Things change based on what the opportunity, supply and demand.
Absolutely,
prices change. That's what happens. Going on, it says housing inventory needs to increase. The substantial rise in homes for sale is needed to ease upward pressure on prices. I couldn't agree more. We need more houses. Markets that see inventory improvements in 2026 are likely to experience more balanced conditions and greater buyer opportunities. Mortgage rates need to fall. I'm seeing rates in the mid sixes right now, and I've seen some 6.25. I've seen some 6 3.75. They're all rolling around that middle 6 number, and that's not a bad number, by the way. But if we do get under 6. My fear is we get under 6, the market's going to heat up again, and we're not going to see prices come down.
No, I mean, the other factor to that would definitely be the inventory. If inventory stays at the higher level, interest rates come down, we will probably see that 1 to 2%. But if the inventory comes down and rates come down, you're going to see some increases in prices quickly.
No doubt. But here's an interesting thought. Those sellers out there, those sellers who have been holding off, waiting for interest rates to come down, that could offset that ability for prices to drop because that would soften the ability for prices to go up, forgive me, because it would add more inventory like you're suggesting.
Right.
More sellers would bring their houses to market to trade off and go to a different house. We might see a lot more of that based on the fact that they're sitting on a low interest rate and don't want to move until they see rates that they feel more comfortable with.
And then they're going to act and
it's going to be a two-way street. They're going to buy and they're going to sell. They're going to do both. So that could make things interesting. In October, a typical home cost $363,932 according to Zillow data. Buyers who put down 20% on a house and finance at 6.17 have a monthly principal and interest payment of $1,777. I mean, the median rent for like a one-bedroom apartment is $1,400 right now here in Vegas, so that's not bad. Homeowners who bought a home at the same time in 2024 at a typical price around that same price when their mortgage was $672 are paying about $100 more, $1,883 a month. That tells you what you could save if you refi.
Yeah.
That tells you what you can save. You could move from 1883 to 1777 right now. You might not want to do that. You might want to wait till it gets a little lower, but you can save yourself $100 a month if you refied right now. If that was your rate then. And that's moving from 672 to 617. I think generally mortgage lenders will tell you shouldn't make a move unless you go at least 2 points or a point and a half.
Yeah, I mean, and depending on the situation too.
Yeah.
I would tell people 1% just depends on what your goal is. If you're shortening the term,
right,
and saving money, you might want to look at it. But everyone's situation is different.
Yep. It goes on to say, housing inventory forecast, when will there be sufficient supply to reduce prices? This is what we're talking. Given the pent-up demand for homes, a decline in mortgage rates, especially a sharp one, could quickly shrink housing supply. And speaking of home prices, here's what the latest home values look like around the country. They give us a chart, and they range anywhere from $169,000 and change up to $824,000 and change for the median price by state. And Nevada, they're showing us kind of towards the high end, but not at the top. California's clearly the top. And Hawaii, California and Hawaii are nuts, as always. Here's the question: should you wait to buy a home experts weigh in. Buying a home in any market is a highly personal decision. Best timing for your purchase will only depend on your specific situation. Of course, if you can't afford it, don't buy it.
Don't buy.
However, if you're trying to predict whether housing markets and affordability will be better in 2026, experts say this probably is not the best home buying strategy. And that's right.
I don't think it's ever the best home buying
No,
strategy.
I mean, don't wait for the market to get to a certain point. But if you can afford it and it works for you, buy it. The market will change. I guarantee you that.
It's going to change one way or the other.
Yeah, right.
And when you're talking about affordability, you're probably talking about the monthly payment.
Right.
If the monthly payment is what you can afford and can pay,
Right.
then why are you not buying?
Absolutely. The housing market, like so many other markets, is almost impossible at times, says Orphe, oh my goodness, Devungi, forgive me, senior macroeconomist at Zillow Home Loans. The best time for a prospective buyer is when they find a home that they like, meets their family's current and foreseeable needs, and they can afford.
Absolutely.
Isn't that what we just said? I mean, honestly, guys, you got to think about it those terms. That again, make that first step, and then the rest of them become a lot easier.